Well, good morning, good afternoon, good evening, depending on where you're joining us today. Welcome to this webinar on accounting and reporting for fiscal commitments and contingent liabilities that has been organized by the Finance Chapter of the World Association of PPPs. My name is Johnson Kilangi, and I'm the chair of the Finance Chapter. I want to welcome you all to this 90 minutes session. And the idea is to make sure that we can unpack this hot topic that keeps affecting many governments across the globe. So to help me discuss this topic is a host of panelists bringing vast experience, both from the private sector and also from the public sector. We have today Mr. Sergei Samolis, the CEO at PPP Expertise Eurasia. We also have Puja Sharma, who is a director at Finsol Amigos Company Limited. And we also have Mr. Eiad Omaish, who is a financial analyst at the PPP Unit of Jordan. And lastly, we have Mr. David Wright, who is the director at PPP Solutions Ltd. So before we begin, I want to give quick highlights about the housekeeping guidelines. We are going to have a session to discuss the topic, of course, getting views from the different panelists that we have. And thereafter, we are going to have up to about 15 minutes at the end of the session to respond to the questions that and comments that you might have. And so we'll try as much as possible to dedicate time to respond to your questions. As we continue with the discussion, we ask those who have any questions or comments to address them in the chat box that we have right in front of your window, and we'll try and allocate those questions to the panelists that we have. So the idea here is to make sure that we have a discussion, an engagement. We want to showcase experiences from the panelists, as I said, from the private sector and also from the government side. And we are hoping that at the end of this webinar, you leave more informed about how best to manage the fiscal commitments and contingent liabilities in the projects that you're handling. Allow me to use the abbreviation FCCL to denote the fiscal commitments and contingent liabilities as we continue with this discussion. So I'll start the discussion, and I'm going to allocate 5 minutes to each of the panelists, and I'll want to just get an overview of each of the panelists' understanding of FCCLs and perhaps highlights of their experiences advising government or managing PPP projects and challenges that perhaps they have faced in their role advising governments or offering advice to PPP projects. So I'll start with Mr. David Wright in the next 5 minutes. Please, the floor is yours.
Excuse me. Johnson, thank you very much indeed. Ladies and gentlemen, I'm very pleased to be able to discuss in particular the UK's approach to managing FCCLs within PPPs. You'll probably know that the UK has a long history of using PPPs to deliver public infrastructure services, most notably through what's called the Private Finance Initiative, PFI, and its successor, PF2. I was involved in the very early stages of the development of the PFI program. I procured the first 2 prisons and a number of schools, and I worked for some time in the Treasury developing PPP and including in that development discussions on how we might calculate and account for the FCCLs that would build up as a result of procuring these assets. And of course, in the last 20 years or so, I've been helping other governments around the world. I won't list them, too many of them. But I do want to make some initial comments on the UK practice because it is quite well developed. And first I want to talk about the management of FCCL. I'll get on in a later session on how to calculate them, but managing them, first of all, the government publishes detailed reports on contingent liabilities to ensure transparency and to inform stakeholders, not least parliamentarians and taxpayers, of the potential fiscal risks. There are several ways they do this. Each government department releases annual reports detailing their financial activities, including CLs. There are what are called the whole of government accounts, WGA, that's compiled annually by the Treasury, consolidating the financial statements of over 9,000, I think it is, public sector bodies. And then finally, there is something called a Contingent Liability Central Capability Report, published annually. In relation to fiscal risk management in its entirety, a structured framework is in place to assess, monitor, and manage the fiscal risks associated with PPPs. And this includes setting limits on commitments, reviewing the exposure to contingent liabilities on a regular basis. And finally, in this part, budgetary controls. The government's developed over centuries a way of establishing control totals for commitments arising from off-balance sheet contracts, such as PPPs. For instance, a limit of £70 billion was set for the period between the fiscal year 2015-16 to 2019-20 to manage these commitments effectively, and these are sort of rolled forward every so now and again. Now, challenges. That's what we do. There are some real challenges, which other speakers will talk about as well, I'm sure. The valuation of contingent liabilities, estimating the potential cost of CLs is, well, inherently uncertain, and it is very difficult to assess the true fiscal risk accurately. Off-balance sheet financing. While some PPPs can provide infrastructure without immediate impact on public debt figures, they often obscure the long-term fiscal commitments, and this leads to an underestimation of fiscal liabilities in the future. It's a serious problem. And then market perception is a challenge. Changes in fiscal rules, just as happened just in the last week with our new Chancellor, or increased borrowing to fund PPPs can affect investor confidence, as it has done in the last few days in the UK. The recent discussions about altering fiscal rules just shows that if you allow more borrowing for public investment, it does raise concerns in the bond markets. So finally, the key lessons, transparency. It's very important. In order to maintain public trust and ensuring informed decision-making, to make sure you have regular and detailed reporting of FCCL. Second, having robust frameworks in place for assessing and managing fiscal risk, and that obviously helps in identifying potential issues early and therefore being able to mitigate them effectively. Finally, continuous monitoring. An ongoing evaluation of PPP commitments and their fiscal implications is absolutely essential in order to adapt to changing economic conditions and indeed project performance. So in very quick summary, while the UK has developed comprehensive practices for managing FCCL in PPPs and other projects, continuous improvement and vigilance are necessary to address the inherent challenges and to ensure fiscal sustainability. Thank you.
Thank you, David. I'll definitely be coming back to you for additional comments as we progress. Over to Sergei Samolis. You've been involved in quite a number of projects and actually you're building capacity around PPPs through your firm. Perhaps for the sake of those who might not have interacted with FCCL, perhaps it would be good for you to give us background. What do you understand by FCCLs and highlight your experiences and challenges advising or managing FCCLs in the projects that you've handled. Over to you, Sergei.
Thank you, Johnson. I'm Sergei Samolis. I'm joining this call from London, and I worked primarily with banks from the lending side in PPPs for about 15 years. And lately I run a consulting and training company. And primarily we work in emerging markets, Eastern Europe and Central Asia. And I co-chair WEP's regional chapter on Eastern Europe and Central Asia. So we just heard from David basically what the most experienced practice on FCCLs is. And most of the countries that I work at, our company works in, are those of the less experienced who are just recently started their practice with PPPs, and FCCLs is one of their current major challenges. So when you asked for the identity what FCCLs are, just to be on the same page, fiscal risks and contingent liabilities. So fiscal risks is basically the exposure of the government of the budget to PPP projects, and they can come as direct liabilities, which are easier to record, particularly if we talk about PFI type, availability payment type scheme, when there is a schedule of payments from the government to the private partner. But also there are contingent liabilities, which are contingent, meaning dependent on certain events. These are responsibilities of the government as per the PPP agreement to provide funds. The most obvious of those would be your early termination scenario, when in case the project falls apart, the government will get back the asset. But there may be provisions, there usually are provisions in a PPP agreement on repaying the outstanding debt and so on. So the government may be liable for a pretty big amount of money to pay over a pretty short period of time. And these are not so obvious, as David said. They depend on events, probability of these events and impact should be taken into account. So collectively known as FCCLs, we can also look at them from a different perspective, talking about explicit and implicit liabilities. So explicit ones are easier to capture. So they are explicitly mentioned in the PPP agreement, but some events, the government may find itself needing to allocate more funds as a result of some events in a PPP project, which are not explicitly mentioned in a PPP agreement. The easiest of those to mention would be your legal fees, either as a litigation or some kind of protracted legal argument. So these would be implicit, but not easy to evaluate. So where we work mainly, so my company, recently we did a project, we finalized an advisory project for the World Bank in Uzbekistan for drafting the FCCL governance framework. Currently, we're finalizing a similar work for Asian Development Bank in the Kyrgyz Republic. So these, I would say and my experience from Russia as well and other former Soviet Union countries, I would generalize to say that the cycle a lot is when PPPs first make their way to a new market. First, there is a bit of resistance with the public sector. PPPs have to prove that they are a good mechanism for procuring projects. Then usually there is a phase of exuberance when PPPs start being appreciated and there is a drive for more PPPs. You have your PPP champions. And that's the stage where many of these countries found themselves recently, when there's a good pipeline, first few deals, and only after that, usually, there is an attempt to come to reckoning how much of these fiscal commitments, what is the total exposure. And that may be, at that point, quite difficult to capture. In Russia, there was a discussion, and so how much of fiscal commitments has the sovereign, all the budgets accumulated, and estimations differed by the factor of 10. And it's quite exciting in republics of Eastern Europe, Central Asia that we work at. So I'll probably deal more about those experiences in later questions.
Thank you, Sergei. I'll move over to Mr. Eiad. You've been involved in the evaluation and monitoring of FCCLs in the PPP unit of Jordan. Perhaps give us your understanding of FCCL. What has been the experience? What is the framework like in Jordan? And what do you see as challenges managing FCCLs for your PPP projects?
Okay, thank you, Jonathan. And I'm very happy to be here, okay, and discuss FCCL, okay, and PPPs. In Jordan, okay, that we are managing the FCCL, okay, by the Fiscal Commitment Unit at the Ministry of Finance, which is a separate unit, okay, that is specialized in preparing, okay, the FCCL report, okay. And the preparation of this report is according to our PPP law, where the law mentioned that before taking the decision of accepting or exercising a PPP project, it must be, okay, approved or recommended, okay, by the Fiscal Commitment Unit at the Ministry of Finance. So this is, okay, regarding managing our fiscal commitment units. From the government perspective, as we know, each government, it wants, okay, to develop its infrastructure, either in having a new infrastructure or rehabilitation or operation or maintain or managing, okay, and operate this infrastructure in efficient and effective way. To do this task, the government either can go to its budget and cover these things, okay, these payments, or go for borrowing or from grants. This is for the developing countries like Jordan. One of the options that we have in Jordan, which is PPPs, and PPPs in Jordan started since 1994, where we have more than 40 PPP projects in various sectors. Now, these projects, okay, it has fiscal commitment and contingent liabilities, and the government understand these PPPs are not free. This means there is a cost for implementing these projects. The cost of these projects either through direct liabilities, okay, which is called fiscal commitments, or indirect liabilities, which is contingent liabilities. And the government is focusing on these things, okay, before taking or exercising the PPP projects. When we say direct liabilities or fiscal commitments from the government side, these are the payments that are clear, okay, that the government should pay during the contract of the PPP projects, either through availability payment, viability gap funding, or shadow tool payments, okay. And these payments are registered or it appears in the government budget, okay. So it is a direct cost. From the other side, there is the contingent liabilities, which is still now, it is not shown in the government budgets, but the IMF, okay, recommend for Jordan to show that these contingent liabilities that arise from PPPs should be, okay, appears in the budget. In regard of calculations of these contingent liabilities and the fiscal commitments, in general, there are various tools, okay, that used, okay, to calculate fiscal commitments and contingent liabilities. And these tools, it could be an international tools like a BFRAM tool, which is a tool that developed by the IMF and the World Bank. There is another tool which is implemented by the OECD, which is called the OECD Value for Money Toolkit. there is an assessment tool which is prepared by EIB for risk assessment tool, okay? Or there is another option that give each country to design or to develop or customize its own tool to evaluate its FCCLs. Okay, so this is depend on the country decision what it wants. So they can use what is offered by the international financial organizations or design its own tool. From the other side, okay, the preparation of the fiscal commitment and contingent reports could be vary. Some countries, they prepare the FCCL report at the early stage, which is at the screening projects. Okay. Other countries, okay, they use it when they prepare the visibility study, and others when they have a winner bidder, okay, offer. So it's different from one country to another. But in case of Jordan, okay, and according to our law, the FCCL report is prepared, okay, when we have a winner bidder. This means we have bidders who are offered their financial proposal and technicals and evaluate these proposals, and we choose the best one. In this case, we will prepare a fiscal commitment and contingent liabilities report by the fiscal commitment unit and put their recommendations, okay, to implement this or not. The idea of having these tools, okay, whatever the tool that used, that these tools that are designed, okay, based on the country macroeconomic assumptions and the project specification. Okay, so based in the country economy, based in the economic variables such as inflation, such as GDP, such as interest rates, okay, the contingent liabilities will be determined. طبعا, we have a specific tool that we use it, okay, let's say, or a base that use it to find the contingent liabilities, which is using the Monte Carlo stimulation or a sensitivity analysis. These two things, okay, that are available in each tool, and this will help the country, okay, or the government to see what are the contingent liabilities that may arise in various situations. Okay, so this is for what, okay, each model should have. In case of Jordan, we are using a BFRAM tool, okay, to find fiscal commitments and contingent liabilities.
Thank you. And I'll come back to you. You've definitely highlighted a very important aspect there of FCCLs. But let me go back hear from Puja, and then we'll come back to you in the next round of questions. We definitely want to hear how you account and measure FCCLs in PPP projects. Puja, if you can hear us, briefly, if you can give us your views on FCCL. You have been involved in projects in Asia and also in Africa. What are your highlights? What do you see being the practice, and what do you advise going forward as to how to better manage FCCLs?
Sure. Thank you, Johnson. The thing that I have encountered is, more importantly, when you have your concession agreements, the contingent liabilities are mentioned there. So the direct liabilities you can easily account for, as my fellow co-panelist mentioned to you. The contingent liabilities are liabilities which may arise upon instance of a certain event that will occur. So it is important to understand that how you account for it. A lot of multilaterals and bilaterals have started creating tools to account for it, but it has not been implemented in a very wide manner in our experience. So if you remember, when COVID happened, a lot of the projects, in fact, majority of the projects across the world were using their contingent liabilities clauses. You know, there are cases, there are legal battles that happen. There are disputes in claims by contractors and developers, understanding of the clause. So what we are inculcating in Asia and Africa, in the current stream of government, there is a lot of emphasis in understanding how these tools, how this contingent liability needs to be measured, and how do we account for the risk. So if you account for your risk properly, the liabilities may be tackled in a very nice manner. So in Government of India, they have developed a contingent liability toolkit. This is a toolkit very specific to the Indian context. It helps you calculate your contingent liability based on the concession agreements that are already approved by the Government of India. My colleague mentioned that in Jordan also they are following a similar tool. So what we are doing now, we are taking these toolkits and going to the ULBs and states so that they can also understand in terms of when they do a project, what is the liability that they are signing up to. When we do a project, we all do financial analysis, but it is very rare that you actually do a contingent liability analysis. But these toolkits help you understand at any point in given time, before the COD or after the COD, what kind of events can lead to claim disputes. So it is very important that as we progress in the PPP area, we all take contingent liabilities very, very seriously, because once they start arising, they can enhance the project cost by 2x, 3x, and at times 10x. That has been my experience so far.
Thank you very much, Puja. I'll definitely come back to you regarding the same and the experience that you've had in India. I'll now move to the next round of questions addressed to each of the panelists. And I'll start with David. So you've been involved in quite a number of PPP projects and also in the UK government advising on PPP projects. Perhaps you could give us your views as to how governments can effectively manage contingent liabilities arising from guarantees or other PPP projects. Over to you, David.
Thank you, Johnson. In my opinion, whatever you do to calculate contingent liabilities at the outset, a much more important matter is how do you manage the liabilities in these types of projects. And the effective management of anything is crucial, but if you don't get this right with contingent liabilities, it literally can be a very serious problem for the Treasury, for a government, and indeed for taxpayers. And that's because the risks that we're talking about here are really significant. In the case of termination, which Sergei mentioned, they're almost unquantifiable because it depends upon the nature of termination. It depends upon the point during the contract tenor that the termination occurs. And of course, it depends upon the method of calculation at that point. So trying to maintain and manage the contingent liabilities just for potential terminations, when, as in the UK, you've got several thousand PPP projects, it's the risk to government finances is well, it is literally incalculable. So, and the reason for that here, as you've heard, the contingent liabilities, they are liabilities contingent upon something happening in the future. These could be guarantees, they could be commitments that are in the PPP agreements. Each one has the potential to impact public finances unexpectedly. Therefore, you need a robust framework of management, and also something that's not particularly present in public services, strategic foresight. Now I can say that because I was a civil servant for many, many years. And I had to say, I and colleagues were not terribly good at strategic foresight. So let me just outline a few key steps and insights from my UK experience. Drawn from the UK approach, which might be able to be applied broadly across different governments. I'm not sure. So I come back to this point about transparency. And honestly, even if you get something wrong, as long as you're transparent about it, the criticism and the damage might be less than if you try to hide it. It is absolutely foundational. It's an element of a construct which is it's often sneered about, being transparent. So, as I mentioned earlier, in the UK, contingent liabilities are documented regularly, annually, in several key publications, such as the WGA, the Whole of Government Accounts, the departmental and agency annual reports, and the specific reports from the Contingent Liability Central Capability, a body just set up to do this. And these reports are published annually. You can find them on the internet. And they serve not only to inform the stakeholders, but also to maintain public trust. So if you commit to regular, transparent, and comprehensive reporting, then governments they're better able to gauge their exposure and enable more informed decision-making among public and private stakeholders. Informed decision-making doesn't necessarily make the decision better or more likely to be right, but at least they're informed rather than guesses. Second point, so we've got transparency and comprehensive regular reporting. Secondly, in order to be able to do this, you've got to have a well-structured risk management framework, a financial risk management framework. That's essential for understanding first and then mitigating contingent liabilities. Now, the UK, as a publication, it's called the Orange Book. Well, we call it the Orange Book, which provides a lot of detail on risk management principles and how to apply those principles, and it is updated regularly. And this framework integrates risk management within the organizational activities and decision-making processes of a ministry or a department or an agency or Quango, any of these 9,000 public bodies. So in turning risk management into a primary activity alongside and within all the other organizational activities, it stresses good governance, firm leadership, and collaboration with others. And these are elements that are absolutely indispensable for managing the risks associated with PPP commitments and involving the private sector as well. I'll repeat that: governance, leadership, and collaboration. That's a framework of integrating risk management within the organizational activities of a government department, ministry, etc. Defining risk appetite and the limits of risk. Right. Now, it's not something that many governments appear to do, but defining a government's risk appetite, and we might well see a good example of that starting in the middle of January in the United States of America. That's essentially the level of risk that it is willing to accept. That guides how that jurisdiction will approach PPP agreements. In the UK, as an example, a cap was set on off-balance sheet commitments, thus limiting exposure to the risks associated with off-balance sheet commitments. One risk, when we were in the European Union, was that the Eurostat office decided to assign our off-balance sheet projects being on balance sheets. So we immediately had a public debt problem. And that meant that we were possibly coming up against the legal limit within the EU of the extent of our public debt to GDP ratio. By establishing and communicating these limits, governments can make strategic decisions about which projects to pursue, some more risky perhaps than others, and how to structure the agreements, perhaps allowing certain guarantees in order to guarantee the success of the project, even if that meant in due course the taxpayer having to pay more money. But it's done strategically, not on a project by project basis.
Thank you. Thank you, David. Sorry, David, I'll come back to
finished.
you.
All right, okay.
Sorry.
That's all right.
We are quite limited in time, but I'll definitely come back to you, David, with your insights on this topic. Before I hear from Sergei on capacity building on FCCL, Eiad, perhaps you could let us know how you measure FCCLs in Jordan. You had actually started discussing on the same in the previous session. Could you kindly showcase how this is done in Jordan?
Yeah, in Jordan, okay, as I mentioned earlier, we use BFRAM tool, okay, where this tool, okay, we entered our data, okay, either it's related with the project specifications, okay, the type of the project, the size of the project, the structure of the projects, and also we enter the macroeconomic, okay, data. So based on the Jordan, okay, economic situation during the previous years, okay, we can estimate our contingent liabilities. Okay, هلا الdirect liabilities, it is clear, okay, it is specific, okay, as it is mentioned in the in the feasibility study, okay, as availability payment or a shadow toll or availability gap funding. For contingent liabilities, okay, in our model we focus on the termination, okay, value, okay, in case if we have a default either from the government, okay, or from the private sector. Also, we focus on changing, okay, in the inflation, okay, rate, okay, how it will affect, okay, and also if any force majeure may affect, but mainly, okay, in our contingent liabilities, we focus on the termination, okay, compensation. Okay, and this one, okay, is, as I told you, use it through the BFRAM tool and using, okay, sensitivity analysis. So this is how we calculate or how we compute our contingent liabilities.
Thank you, Eiad, for that. Over to Sergei, your company is involved in capacity building. What do you think should be done to build capacity within government institutions as to how to improve on the management of FCCLs?
Indeed, most of our work as consultants is helping governments to improve their capacity. And in terms of FCCLs, in the regions where we work, the emerging markets, developing economies, first of all, it's quite rare to see a fiscal framework already well developed, and I'm talking before PPPs appear, a fiscal framework across all PPP contracts, traditionally procured ones. So the only opposite example that comes to mind is we're doing a PPP roadmap for Armenia. So there's not much of PPP pipeline done. There's not yet a PPP unit established, but there is, as we analyzed, a pretty detailed advanced FCCL framework. But most of the time when you start, there's, as I said, after the starting phase of exuberance about PPPs, then comes the reckoning of, so very often countries would already procure a few deals, very often with the help of international financial institutions, working as advisors, transaction advisors. But the role of the transaction advisor usually stops at commercial close, financial close, but then you have your project implementation phase, your contract management. So there may be a wonderful agreement, there may be a very advanced, good financial model, but usually then the team, the public sector team, is left at its own devices without someone holding their hand. And it turns out it's challenging even to implement a very good agreement. And we've seen cases when some clauses were not implemented because it's even difficult to interpret the agreement correctly. And of course, occasionally, some government agencies were surprised to see that they need to allocate some funds. They were expecting PPPs to be something built free of charge, and then maybe generating some concession payments. So we see, first of all, there is this legal framework, the manuals, all your documents, and there's also a very important institutional aspect to capacity building. So in terms of documentation and methodologies, everyone looks up to the UK experience in terms of how to evaluate contingent liabilities, how do you use statistical methodologies. But turns out, at least from our experience, those institutional aspects may be more challenging. So when you start trying to create an FCCL framework for an existing PPP pipeline, so your task always needs to go wider. So you need to fit it in a existing PPP procedure, PPP framework. May turn out that the existing PPP procedure does not really work perfectly for accounting for fiscal risks and contingent liabilities. Also, there is a wider PIM, public investment management framework. Does it allow for all of the type of accounting, whole of government's accounting? Does it allow for disclosure of liabilities that David mentioned? So often a task of a consultant turns out you need to expand your scope, or you need to say, look, there's broader work to be done. So one of the specific elements that we came across, I can mention, is, I would say, first of all, the early stages of project identification and screening. So in many of the countries, the early stages are sort of combined. The identification screening is combined with assessment where advisors are already contracted. So in many cases, there is no mandatory PPP screening report, would not have a mandatory fiscal affordability aspect. So is the Ministry of Finance being asked at an early stage, are you at all capable of allocating these availability payments or not? So it would be a shame to see a lot of due diligence advisors working just to, after they've produced their reports, to realize that the government could not really afford this project in the first place. And I'll just also mention one more aspect is the involvement of Ministry of Finance. So the good advice is even if the leading ministries, the procuring authorities, is your sectoral ministries, and let's say the Ministry of Economy plays a big role, your investment agency plays a big role. But it's important to make sure that the Ministry of Finance, they are included in the approval process. And not only approval, quite often approval stops at the project is launched, and sometimes there's a preferred bidder announced, but what happens during and after negotiations? Negotiations often lead to additional changes in the PPP text, in some data, in the financials. It can lead to significant change in exposure, fiscal exposure of the government. So is it being approved again by the Ministry of Finance? And finally, is it being monitored, as David mentioned? Not many countries that are new to PPPs have this annual reporting phase, annual accounting for fiscal exposure, let alone having it in a transparent disclosure way. Thank you.
Thank you, Sergei. And lastly, to Puja, why do you think effective management of FCCL is important for public financial management?
It is very important, Johnson, because right now, specifically in most of the developing countries, like India, Kenya, Tanzania, they're doing projects, but there's no record of how guarantees are being assigned, how commitments are being given by the government. There is no record that is being maintained. And we are in the times wherein being on your own foot, as we call it, is very important. Whether you are a ULB, whether you are a county government, whether you are a state government, or you are the federal government. So the importance that people need to understand that if I am going to put a guarantee in it, maybe it is a exchange rate guarantee, maybe it is loss deficit, revenue loss deficit guarantee. I need to account for it. And then I need to budget for it. Like every year, I need to budget that if I am going to do, if I'm going to have 10 projects as a county on PPP basis, in year one, what is the kind of contingent liability I may be hit by? Because none of us were prepared for COVID, and then COVID arrived. And all the PPP contracts in the world got hit by it. So there was change in law, there was unforeseen event, and because the revenue was not normally derived, they were all in losses. They could not meet their basic obligations. So all the contracts had to be given leeway. But it has given us an eye-opener that something or the other can hit you without knowing. And most of the governments, unfortunately, do not do a long-term planning. The financial forecast for a budget does not go beyond 4 years, 5 years. And that too, it takes into good account the immediate next year, but not the next 5 years. Like when we do our own companies, when we even do our household budgets, we account for our children education till they graduate. We don't account for them to be, passing kindergarten and then going to the junior school and then going to the high school. So the same methodology, what we are trying to tell all the governments that we work with is that you need to be aware of it. We are not saying you keep aside your budget or you keep aside your project, you don't do your project, but you be aware that if this happens, there is an obligation that you will have to pay. And Sergei very, very, very keenly and very rightly said about the legal cost. They are never talked about. And these legal costs are the most expensive costs that both the parties pay for, whether it is the government or it is the private sector. There is no account for such legal cost in any of our documents. And we don't know, even as a project, if I have a dispute with the government, I will hire a lawyer. But the fees that I will pay to the lawyer could actually overturn the amount I'm seeking from the government as compensation. And it's not that it was a fault or it's a mistake at the end of the public sector, but it is also learning as we go along to be more prudent in our approach. And as David rightly mentioned, transparency is the key for PPP to be successful. And you can only be transparent if you manage your risk very well. And to manage your risk, you need to know them. And to know them, you have to quantify them in some manner or the other. I am not saying that whatever we will do will be 100% correct to the last decimal, but it will give you an approximation. Last year in India, there was this report on road construction department, which is called National Highway Authority of India. They have, because they're one of the most prominent agencies who do PPP projects in India and construction of roads, infrastructure. Their contingent liability is 0.5% of the GDP of India, which they have reported, which is their existing cases, which is the cases that people have put in claim for. But for projects which they have not claimed for, where they have not gone for any dispute, we don't know what it can lead to. So what we are suggesting now to all the governments, whether they are county governments or federal government, is when you execute a project, you also calculate your fiscal liability, your contingent liability that may arise, and how it will be different. There are tools that are being developed by World Bank, Asian Development Bank, respective governments that you can use as a practitioner. It will just give you an awareness. You know, if I have a budget of say $100 and I cannot be sitting on a contingent liability of $500, it's a clear mismatch. In a way, it will also be prudent approach to manage your own balance sheet at each government level for the officers. The challenge we also face that, you know, because the government jobs are transferable, if you worked on a project and you closed it, and then you moved on and I took your place, now I don't get the files. I don't get the knowledge transfer of what you interpreted of the agreement. You know, so that is also something that we are working on, that, you know, there should be, like in private, when you hand over your work, there is a baton that is given, so the other person is fully capable of executing your work in the same terminology as you would have done. So we are also working on that, you know, when you do these projects, the filing and the storing of project document data is very, very important. Because these are, you know, 20 years, 30 years, 50-year contracts. God knows what will happen in another 10 years' time. And if we don't have the project document at the financial close, for instance, then there is no way after 10 years, anyone in the world can decipher what was interpreted when it was executed or when it was implemented. So it is very, very important that we start using these tools as and when we are developing and structuring our PPP projects. You know, we'll keep it at the back of your mind that I have to work on this aspect also. Right now in our feasibility reports, in our pre-feasibility reports, we do not talk about these. The good thing is that when your concession agreements are signed or when they are drafted, all these agreements are put into it. So you're covered from a legal perspective, but they haven't been quantified, or the methodology to quantify these aspects has not been provided for. So a lot of these agencies, multilateral agencies and respective governments are emphasizing on the project development team, especially the PPP units, to work in this area and to develop it so that you understand what liabilities you are carrying with you. And hence, when you know it, then you can prepare mitigation matters around it.
Thank you. Yes, Puja, thank you. Thank you so much for those insights. I'll definitely be coming back to you with more comments on this subject matter. So before we take the last views from the panelists, for those who have just joined or joined later after we started, please, if you have any question you'll want answered, please feel free to post it in the Q&A box that is available on the lower section of this Zoom window, or you can alternatively post it in the chat box. We'll get time to respond to the questions that you might have raised. And so I'll move to the last round of questions to the panelists, basically getting views on some of your experiences and suggestions that you might want to put across to governments so as to quickly build capacity and ensure that we are putting together measures to effectively manage FCCLs. So in a round of 3 minutes or so, just let us know of your views. What is it that you can advise governments so as to make sure that they better manage FCCLs? I'll start with you, David, and then I'll move to Sergei. Over to you, David.
Thank you, Johnson. I mean, governments have got to address 5 main challenges, whether it's through understanding, practice, capacity building. The biggest challenge is the complexity in measuring and valuing FCCL. Now, I've already heard from other panelists examples of contingent liabilities. I'm not sure that anybody amongst us has actually defined what a contingent liability is, and I'm not going to try. Sorry, what it is, what isn't a contingent liability. But I noticed there was a question that asked, how does this apply to social infrastructure? Presumably somebody's thinking, well, when the government pays for a service, where is the contingent liability? Well, apart from those associated with an early termination of the contract, that is a very good question. For example, I would probably disagree that legal costs should be called a contingent liability. To me, those are expenses that are incurred in the normal course of government business. But this is the sort of thing that you've got to be thinking through. Complexity in identifying, perhaps I should say, measuring and valuing FCCL. And we've heard about what the recommendation is, where you use whatever standardized risk assessment models and probabilistic forecasting measures there are around. We heard about Monte Carlo analysis. There are other ways of doing it, using frameworks like our Orange Book or whatever. First point. Second, insufficient transparency in public reporting. I've already dealt with that quite clearly, I hope. Lack of skills and capacity, Sergei mentioned that. Training programs, well, Johnson, you'll know my view about training programs, and I won't repeat them here because it might be embarrassing. I do think there's a need for an innovative approach to building capacity for those people who are actually working on projects, not people who might be, because by the time they come to do it, they'll have forgotten everything they've been taught. Fourth, challenges with off-balance sheet treatment. That's a real problem in a lot of countries, jurisdictions that are doing this for the first time. Again, Sergei mentioned the point, people think they're getting this for free. Fifth one, which again was hinted at by him when he said about bringing in the Ministry of Finance, because FCCL in PPPs involves multiple departments, from ministries of finance to sector-specific ministries. Poor coordination will lead to inconsistencies in FCCL assessment, tracking, and reporting. Different departments will apply different criteria and methodologies. And, as Sergei says, the Ministry of Finance often come in almost after the contract's been signed in some countries, which is absurd. So establishing a centralized FCCL oversight committee or task force to improve interdepartmental coordination is pretty important. So in summary, governments do face considerable challenges in managing FCCL effectively, from valuation complexities to transparency issues, skill shortages. They've got to have standardized assessment models, enhancing transparency through regular reporting, investing in capacity building. How often is capacity building regarded as a cost rather than as an investment? Establishing off-balance sheet limits, fostering interdepartmental coordination. Have I forgotten anything? In that way, and only in that way, can governments take the right number of steps in the right direction to a more robust management of FCCL. It's not just theoretical. These things are being applied in jurisdictions like the UK. Anyway, that's enough from me. Thank you, Johnson.
Thank you, David. Over to you, Eiad. Your comments, highlights, advice to governments on how to better manage FCCLs.
Okay. From my view, point, I see it's very important for each government to have an FCCL framework. This framework is very important, which should clearly mention what is the government methodology in calculating fiscal and commitment and contingent liabilities, and what is the tool that can use. The second point is the building capacity. As Sergei mentioned, it's very important to have people who are professional or have the experience in preparing a fiscal and contingent liabilities report. So if we have a right people who can do the right task, we can give the right output. Another thing related with the preparing the FCCL report, it should be prepared in all PPP project cycle. starting from screening, then preparation, then tendering, and then execution. Okay, and also after transferring the assets, okay, to the government, it's important to continue, okay, seeing its FCCL, okay, outputs. Last thing is each government should not focus on having more PPPs. Okay, I want to do PPP projects. I have one, two, I have a lot of projects. Okay, now I know their FCCL, okay, but according to the government budget, it's very, very important to have a fiscal ceiling for PPPs. This fiscal ceiling will help governments to know at or till what level it can accept, okay, implementing PPPs, okay, because some governments, they have budget constraints. Some governments, they don't have enough money, okay, to cover, they don't have resources. So it's very, very important to have a fiscal ceiling. Okay, this is my insights.
Thank you very much, Eiad. Over to you, Sergei.
Thank you, Johnson. So we've heard so much during this session. There are certainly countries like the UK with vast experience and many solutions which are already available. But every country, there's no one-size-fits-all, I believe, for every country. Every country would find its own solution. The government should seek what works best for them. Some are experienced, some have a lot of data captured already about cost overruns, time delays, so it's easier to try to calculate risks. The point that I mentioned, when do you start trying to evaluate affordability, fiscal affordability? Can you do it at the early stages? Or maybe the market is so new to private investment that there is basically no inputs to start assessing them. So you need to start with some, maybe an early stage pre-feasibility study exercise to develop some perspective of the costs of the liabilities. And then, of course, there are different frameworks. The EU have their Eurostat, the way of treatment. There is international IPSAS standards for accounting for fiscal risks. And the question is where each country stands. As David said, what the risk appetite, largely, that's the question. So Russian Federation at some point refused to take any foreign exchange risk. And that was the reason so many projects never started. Whereas Turkey, for instance, has a different viewpoint, so they stand by some of the key risks, including foreign exchange risk, and that's why so many large-scale projects were financed with great participation of investors and lenders from all over the world. And by the way, Turkey, which is a recipient of IMF loans, IMF was scrutinizing the healthcare program of Turkey, very, very diligently looking at the fiscal space for Turkey as a country, for the healthcare ministry, and so on. So it's being strategic, being transparent, and there's a wealth of solutions. And probably, from my experience, IFIs are one of the best. These are the lenders who have a policy objective. And just to finish, we have this example which I admire, for instance, ADB on their strategic thinking. So when Bangladesh was a history of success with the PPP pipeline. So when the term in office of then head of the PPP agency of Bangladesh, Syed Afsaraddin, was expiring, ADB invited him, allocated him with the role of a strategic advisor for Uzbekistan. He worked in-house for a long time, helping Uzbekistan to be a history success in PPPs. And just as we speak, there is a delegation of Turkmenistan, a new nation, a new market opening up to PPPs, and ADB are taking them to Uzbekistan to learn from the experiences from the projects. And one of our team is there with as a consultant, the one who worked on FCCL frameworks. in Uzbekistan. He's there. So I see it as an example of knowledge transfer from looking at different markets, particularly ones which are relevant next door, to see what worked there. Maybe there are some lessons to be learned for a new market. Thank you.
Thank you, Sergei, for your insights. Puja, for your final comments.
Yeah, since my colleagues have already mentioned, I would only say it is very important that we start looking at this concept in detail. There are successful examples that countries are managing their fiscal liabilities very well. We can look at them as a reference point, and then individually, each country can either adopt a multilateral system that is there, like World Bank has PFRM as a tool. India has developed its own. Chile has very well managed its contingent liability framework. UK has one. Sergei mentioned Uzbekistan and others have also developed their own framework. Jordan has one they are using. So people who have not yet looked at these frameworks could have a look at them, see what fits their geography well, because risks are the same, projects are the same. It's the methodology you want to adopt. And like Sergei mentioned, you have to start somewhere, especially in the developing economies, where it is not prominently done. We also don't do a very good value for money analysis. So it will also help us do value for money analysis and think about it in a different way when I understand that I have budget constraints. So it's the value of each dollar that I can maximize for my citizen that would help us understand how best I can execute this project, which party is the best party to manage the risk, and how much risk allocation or risk weightage should I give to that risk based on the scenario I am in. And this is not one-time activity. It's a continuous activity that you have to do over a period of time. At financial close, before financial close, after construction, operation, then every interval till the time you continue your project. So if you have a 20-year horizon, I see it an activity that you should do at least 5 to 6 times over the period of time. If not every year, because it might become very expensive exercise to do. But we have to start somewhere, because all of us, we know that infrastructure is a constraint in the world, not just in our own countries. If we want to have better infrastructure, we have to manage it betterly. We have to manage it in a way that our future generation can also be taste the fruitfulness of the infrastructure that is being created. And we don't leave something which is unviable or not used over a period of time because we don't have the money or it went into crisis. So it's like you built half the road and the remaining road got into a dispute and it never got completed. So there's no point of doing such projects. We have to be very, very prudent when we are developing, and therefore my keen emphasis is to, when you structure your projects, think the worst. Be very pessimistic. While you're very optimistic of developing something new to the world, but you have to be very pessimistic in terms of what can go wrong with this project. That will give you a good idea in terms of how we manage these kind of risk. That is all I have.
Thank you. Thank you very much, Puja. And so I want to turn and respond to some of the questions that have been presented to us by the audience. I'll request any of you to respond depending on your area of expertise. The first one is coming from Sastyananda Sarangi. I hope I pronounced that correctly. Keeping in view the PPP projects that involve social infrastructure, how can government go about contingent liabilities? I think, David, you had earlier mentioned or tried to respond to this question. If you don't mind, perhaps you could pick this.
Okay, well, trying to keep this at the right level. So social infrastructure is typically paid for by the general taxpayer, not by the user. So that distinguishes it from projects where the user pays all or most of the cost of the project. So we're talking about here public schools, public hospitals, cultural assets, criminal justice projects, and so on. Now there, the payment is quite straightforward. It'll be coming out of the departmental accounts. The contingent, there are no contingent liabilities associated with the availability payment, because that is a payment that's made in the ordinary course of public business, and it's being calculated, and votes are required of Parliament, so the annual accounts have money in to pay those availability charges. The contingent liabilities are likely to be, for these projects, associated with the guarantees that might have been given, minimum level guarantee, minimum income guarantees. For example, in the prisons, we wanted an 800 place prison, for example. So we agreed that we would pay for an 800 place prison, even if there were only 600 prisoners sent there by the courts. Right? But even that is, you could argue, is not a contingent liability. We just knew that the payment would be for 800 places. If there's a guarantee for something else, then that might be a contingent liability or not. Depends how it's calculated in the original calculation of the cost and so on. So social projects actually ought to be easier. We're talking essentially about termination. If a contract does not run to its full course through the effluxion of time, then if it's terminated, there is bound to be some sort of payment through the contractor to the banks, or in some cases to the owners of the special purpose company. And those can be calculated as long as you know what the formula is for compensation. And it has to be done essentially on a yearly basis. So you start off modeling this. I mean, I had to do this myself with my financial advisor, so I know how it's done. So you know, you've got a pretty good idea that if it's terminated in year 6, it's going to cost about this amount of money in today's prices. I mean, I was a professional statistician, so perhaps I have some advantages in being able to do some statistical analyses, which are marginally better than guessing. So I hope that's helped to answer the question, but I don't really know what led to the question being asked. So that's my take on it. Over.
Yeah, thank you, David. I think you comprehensively answered the question. Immediate liabilities and of course contingent liabilities should there be occurrence of certain events in the contract for construction and operation of social infrastructure. We have another question from Enye of the Africa chapter of the WAP. Thanks sharing these great insights on the management of FCCLs. What would be the best practice approach on catering for the unknown, evaluated and quantified contingent liabilities? Do you suggest that governments set aside such amounts in each budgetary cycle? What would taking out specific project insurance policies help? Good question here. I don't know if anyone wants to respond to this question.
Well, a contingent liability is very similar to what if you're bidding for a piece of work, you will actually put into your budget a contingency. And it's the same word, and it's for the same purpose. The private sector will deal with contingent liabilities in their delivery by putting in an amount of money that they've estimated on the basis of earlier experience, and maybe 20% of the value of the contract. Arguably, government could do the same as that, except that Parliament is not very happy about voting money for contingencies. It does, because I suspect that most governments in their annual budgets have something that's called a contingency fund. Again, notice the word contingency. It is for example, the unknowns. And hopefully you have enough headroom in your annual budget to cover contingencies. And the problem is it will never cover the catastrophic events like the pandemic, like the effects of the war in Ukraine. Those you can't put in the contingency for that. In fact, whether a government can afford it out of its first year's, the year's budget is probably not the most important thing. You're thinking about, are people actually going to survive? So whether you've got the budget for it is irrelevant at that point. You've got to find it, typically by borrowing it. So you can only do this sensibly for the likely unknowns, not the completely unknown catastrophic unknowns. Because I'll repeat myself, if these catastrophic events happen, your budgeting is probably the last thing you're thinking of. You're thinking about saving as many lives as possible, of trying to deal with absolutely enormous problems. And you just find the money from somewhere. Don't worry about the accounting, oh, can we spend this money or not? You just do it. And if there are enough of us left after the event, we'll be paying for it for many years to come. I mean, I've seen this happen 2 or 3 times in my very long life. And on each occasion, the events, while they're happening, they're almost too difficult to imagine. And if you're in government, it's extremely difficult to go home each night, if you get home, with a sane mind. So I've been through 2 or 3 of these in my own personal experience. At the end of it, you pick up the pieces and you have to pay for it for quite a number of years afterwards, as all governments will be finding right now because of violent conflicts around the world, because of the increasing extreme weather conditions, and because of the increasing number of viruses, to name but 3. Anyway, I don't want to sound too pessimistic, but we do have to put this into a wider context and not spend too much time worrying about the nuts and bolts. My recommendations have been about processes that apply almost in any business, transparency, just doing things properly. And I agree with Sergei, there's no point talking about FCCLs to a government if they can't even pay your advisors' fees on time. And what's the point? They shouldn't be doing PPPs. And I have to say to some governments, there's no point paying me money to advise you on PPP. You need advice on how to run a government properly first. And that's it. Goodbye. I don't want to waste my time or your money doing something that has no value whatsoever. And I've had to say that to the ADB when they've asked me to do some work in countries that I will not name. I've gone there and within a week I've said, don't pay me any more money. It's stupid carrying on doing this. Stop it until you've sorted out their accounting system, sorted out their government, sorted out their transparency. And we need to be honest about it. It's very attractive to be talking about something it is interesting to me because I'm a statistician and a bit of a nerd, but there's no point doing this unless you've got a good project pipeline, you've done proper business cases, you've got the structures in place for managing contracts. I mean, this is part of contract management. Who talks about contract management when they're doing feasibility studies, for example? Again, Johnson, my views on this. Stop. However, that's
Thank
for
you,
another
David.
seminar. Sorry.
Thank you, David. I think you've answered the next question of Sarangi, which was, as pointed out during the discussion, there's a lack of fiscal foresight beyond the maximum of 5 years. In that case, how can the government plan for fiscal sustainability in PPP projects, which have a concession period of more than 20 years? Sergei, you want to pick that?
Well,
or add to what David has said?
yeah. There is, of course. I tend to look at it more from the private participants' perspective, because they certainly take a leap of faith, and not only the government but the private participant when they enter into a contract with this duration. And any kind of budgeting, usually the budget is for the next year, and maybe some planning for a couple more years. But at the same time, the government takes some commitments for the duration of the contract. So hopefully the government has an accounting system that allows to capture all of those fiscal exposures for years to come. So for instance, for every budget that started, let's say, an availability payment project, their capacity to procure more deals for years to come becomes shorter and shorter. And the likes of Infrastructure Ireland, so they've stopped doing projects because their budget is stretched to service the existing ones. So that they were realistic about doing it. But from the private participants' perspective, because for 1 year there is the budget is approved by Parliament, so it is a law. The government has to abide by it. But what happens in a few years? There may be absolutely different cabinet, which is not so keen on public healthcare or something else. So it is a certain risk. Would it be approved or not? And some of those things need to be analyzed during the negotiation stage. For instance, a large project, I was involved in deals where the public sector was a municipal one, not a national-wide one. And they said, look, if we're discussing the early termination scenario, the amount of this project would be too big for us to pay the possible exposure over 1 year. So it was factored in that there is a cap for the first year, a cap for the second year, and by the year 3, they were supposed to sort out the existing liability. So some things can be done via scenario planning and capturing a realistic scenario in the PPP agreement. But of course, there is a level of, and of course, the contingency funds, whatever additionally allocated, perhaps by insurance, as Enya is suggesting, if there is any additional support like your credit enhancement, effectively you can enhance the credit capacity of the public side, not only of the private side. That would help to make the project more affordable.
Thank you, Sergei. I just noticed we have another question on the chat box. Unfortunately, we have only 2 minutes remaining, so I'll read this from Patrick Wadu. I'm Patrick Wadu, joining from Taita Taveta, Kenya. Thanks to the moderator and all the panelists, the session has been insightful. But how can governments ensure transparency in reporting contingent liabilities? How can governments ensure transparency in reporting contingent liabilities? Puja, you want to take that?
Yes, I can take that. The government needs to come up with a framework. And when I say government, I am more emphasizing on the government at the level which the project is being executed. So if it's a county level government project, then it is the responsibility of the county government. If it is a state level project, it is the responsibility of the state government. And if it is a federal level project, then it is the responsibility of the federal government. But the key aspect to this is that when you do a project, when you do a PPP project, you also account for its contingent liability that may arise for the likable items like early termination, exchange rate risk, revenue loss risk. Those are the things you can easily do. But the responsibility falls with the government who's executing the contract. You can always have a report, a framework by the government at regular intervals, need not be annually, that can say, of the 20 projects we did, this is the contingent liability as of this date that we hold. Because this will only trigger when an event will happen. Otherwise, it's just a calculation. All we are trying to tell is that you should not do a $2,000 project when you only have 100 rupees, when you have only $100, sorry. So that way you can easily manage it, and it will also give transparency to the citizens, knowing that how the government is spending. But it has to be in terms of block periods. It cannot be every year. I don't think it is prudent to do it every year unless you have a very robust mechanism, because not all your projects are going to get terminated. Not all your projects are going to fall in one go. And like David very rightly said, if there's a catastrophic event like a war or a pandemic or tsunami, you are more focused on saving life than actually trying to do my project. And those are different scenarios that we will work in. But in a normal due course, we should always assess over a period of time what kind of liabilities would arise in case this goes for a likable default, which is calculative. Thank you.
Thank you, Puja. Sergei, I can see your hand is up.
Yes, thank you, Johnson. The word transparency is really undercutting points that each of us is making, and I think it goes beyond FCCL's any kind of exposure to projects and any features of the projects, such as value for money. It's very good if there is a framework of reporting or disclosure of information about the status of the projects. It could be done in advanced experienced economies, could be done annually. So if I look at the annual reports of the IPA, Infrastructure and Projects Authority in the UK, it has a report, it has a status like this green, amber and red a status of the health of the project annually for each of the projects above a certain size, PPPFI ones and directly procured ones. And when I worked at a bank, I was lamenting about my KPIs were all about signing and disbursement volume. And when I thought, I made a point saying I stopped so many bad deals, there's no way I'm being rewarded for that. So this UK experience, in a way, is IPA often say we saved the taxpayer this amount of billions of pounds by stopping projects that are in the red zone. So checking the health of a project, not only when it's being procured, but throughout its life cycle is very important.
Thank you, Sergei. Omaish?
Thank you, Justin. Just I want to say something that most of the governments, they're afraid, okay, to publish their contingent liabilities in their budget because they don't want to raise or to increase their public debt. Okay, so again, transparency, as my colleague said, is very important. It's very important to publish. Okay, so the others, the people, the citizens, the other international organizations can know more about the country, PPP contingent liabilities in the country. Thank you.
Thank you, Eiad. So I think we are out of time. I'd like to thank all the panelists for their insights on this subject matter and also getting time to respond to the questions that have been put across by the participants of this webinar. There have been a number of requests by the audience to make available this recording. I confirm that that will be made available as soon as the editing is complete. So please keep checking the YouTube page of the World Association of PPP for a recording of this session. I think the panelists have emphasized on the need to have an effective and an efficient FCCL framework in place so as to help governments effectively manage and report their commitments and contingent liabilities. I think we can all agree that that does not eliminate the need for us to better undertake the upstream project development processes. There is need for us to clearly understand what need we want to meet through the projects that we're putting together. There's need for us to undertake quality feasibility studies. As you know, issues around fiscal affordability, issues around debt are subjects under feasibility studies. So if these are done properly, we are helping the country to push forward better projects that are able to meet the needs of the people. So that coupled with a proper framework and of course a well-capacitated team with knowledge as to how to manage risks in projects and also how to better measure, evaluate and report the FCCLs, then we're able to see a healthier PPP program being implemented by our respective countries. Of course, we cannot conclude this discussion. However, we invite you to channel your questions, your comments, your views to the World Association of PPP. For those who are not yet members, you definitely have a chance to join and become a member of the WAP. Please feel free to reach out through the contacts that are available on our website, and we'll respond to your questions. Thank you very much, and thanks to all the participants and the audience. This would not have been possible without you waiting and listening to the entire session. Thank you very much. Please feel free to contact us. We will definitely be organizing more sessions like this, discussing issues around financing, around structuring of PPP projects, and the idea is to make sure that we build capacity globally on how best to implement quality and impactful PPP projects. Thank you very much and enjoy the rest of your day. Thank you.
Thank you. Bye-bye.
Thank you.
Thank you.